Hello, everyone. This is Ted Bauman here, editor of the Bauman Daily, as well as the Bauman Letter and Profit Switch. And on that score, just want to point out that Profit Switch is actually available. You can see a link up here and in the description below. My service is expanding. We have a number of triple baggers. We're doing very well, and we are entertaining the possibility of bringing new people on board. So please consider signing up if you're so minded. We will definitely take care of you. Now, I'm going to talk about the economy today, but I just want to point out beforehand, a lot of people accuse me of being a perma bear. They say I've been calling for crashes forever. They say, essentially my investment advice is not to invest in stocks. No, that's not true. I do believe that there will be crashes someday. Uh, Sometimes it appears from the perspective of some of the marketing stuff that comes out, it looks like crashes are inevitable. They are inevitable, but you never know when they're going to come. And in the short term, in the meantime, you have to look for opportunities. That's my approach. The difference is I may not be a perma bear, but I'm also not a perma bull. I'm a realist. I'm an economic historian. And so I know that when people say this time is different, they are looking for trouble. Now, I want to talk today about interest rates. I want to talk about the possibility that they're doing something that nobody really thinks about very much, the opposite of what a lot of people believe they do. Now, from the perspective of the stock market, we know that high interest rates are bad news. They're bad news because they make bonds and investment in debt more attractive, which leads people to reduce their exposure to equities, which leads to overall downward pressure on stock prices because it withdraws liquidity from the stock market and it directs it towards bonds and debt. On the other hand, high interest rates make the future earnings of companies seem less attractive, which theoretically makes their stock prices less attractive. Although I would argue that at the moment where we are driven mainly by speculation, stock price speculation rather than fundamental analysis, I'm not sure that makes a great deal of difference, at least not for the story stocks. But here's a challenging perspective I want to present to you. What if low interest rates actually cause slow economic growth? What if low interest rates actually make the economy less dynamic, reduce incomes nationally over time, basically is bad for the economy? Well, that would be a pretty radical perspective, but a lot of people, a lot of good economists have actually begun to think that way. And today I want to present an argument as to why that might be the case. Let's start by looking at some statistics, some actual figures. Here's a chart I developed myself that shows gross capital formation as a percentage of GDP in the United States going back to 1979. And there you can see the trend line. It has declined over time. Now, I know some people will immediately say, well, that's because particularly in the internet era, a lot of big companies no longer need to invest a lot of money in capital because they're capital light. They are primarily based on intellectual property, not physical property. I take that, but there's still an unmistakable decline, which I think is needs to be explained because there are plenty of other industries that the United States could be involved in addition to the low capital cost companies like technology. And the fact is that we're not. We've actually moved out of them. And we're no longer investing that physical capital to do things, particularly in manufacturing. Now, again, there's a lot of arguments as to why that might be the case. But I do think that low interest rates have a big part to play in that, and I'm going to show you why just now. Here's the second chart that shows capital formation on a slightly different scale, but against the 10-year Treasury rate here in the United States. Now, that is, again, a pretty clear indicator. As the 10-year Treasury bill rate falls, so has capital formation. And it may not look like a lot, it may not look like a big drop in capital formation, but when you consider how many trillions of dollars are involved, those even a couple of percentage points is a huge impact. And it has a huge impact on employment and all kinds of multiplier effects throughout the economy. Now, why would this be the case? Why would low interest rates be bad for the economy? And in the long term, therefore, bad for investors, even though the short-term cost of raising interest rates may be high. Well, one easy one, and one that a lot of people have recognized already, is that when you lower interest rates, you destroy people's fixed income, the kind of things that people, retirees, for example, have depended on. They no longer really receive anything for their bond holdings. and as a result, they can't live, which means that they have to reduce their consumption. So if you're somebody who retired 10 years ago and you had a 60-40 bond equity portfolio at that time, you're hurting right now, right? And you have to cut back your expenditure because your income from bonds has reduced. So that's one thing, that's obvious, but it's not the big one. The second one is that low rates are associated with a rise in industry concentration, higher pricing by companies, and higher corporate profits, and a decline in business dynamism. Now, why would that be the case? Well, the first reason for that is that low interest rates allow larger firms to invest to increase productivity far faster than smaller competitors. That leads to uncompetitive markets. Let's say that you are a small manufacturer in a large market making widgets. Well, your big competitors are able to access capital at very low rates, and they use that to increase productivity so they can lower prices and undercut you. Now, you could also invest in that um, new productivity yourself at those low interest rates, but the chances of you being able to undercut them or even maintain your market share get lower and lower because the cost of capital is so low for the big guys. So eventually what happens is low interest rates tend to clear out competitive markets and lead to domination by 2 or 3 big players who then have pricing power. They can raise prices at will. And the other thing is they don't have to invest once they get into that dominant position because they essentially are the only source of supply. Look no further than the cable and internet companies in the United States. That's exactly what they've done. They've basically cut back on investment because they don't have to. They don't have any competitors. And one of the reasons why they got so big is because over the last couple of decades, interest rates have been so low. Now, the second reason, third major reason why low interest rates can cause a lack of economic dynamism is that it allows zombie firms to continue to exist. It allows companies that really are not providing any economic benefit to anybody. They're simply surviving by rolling over their debts at low interest rates. They're not productive. They're barely hanging on. But the thing is that all the workers, all the capital, all the resources that are tied up in those companies under typical economic models should be going to other uses. In other words, they're not effective uses from a national perspective if they remain in the hands of those zombie companies. But low interest rates allow them to continue to survive. In a sense, we see this right now with a lot of companies that probably should be shutting down, even under the conditions of COVID. But they're not shutting down because they're able to access super low credit, partly thanks to the Fed's backstopping of credit markets with the facilities that expired at the end of December, but mainly because interest rates are so low, it makes investing in debt very attractive. So even if you're a nothing burger company, you can still get money, you can still operate, and that means that you're using resources that should be going elsewhere. This all creates a feedback loop, and the feedback loop is that this decreasing economic dynamism and growth in the economy discourages more investment because as the economy slows down, as people's incomes fall because companies are not investing, we see that people then take whatever income they can get and they shift it into financial markets. This is also linked to inequality because as the economy slows down, as firms become more hyper concentrated, particularly in the technology sector, you see these enormous fortunes building up. I mean, Jeff Bezos, these kind of guys. But particularly in the financial sector, there's just so much money at the top. Those guys don't have anything to do with it. They can't possibly spend it. They can't eat it. So they've got to invest it somewhere, and they invest it in the stock market, and that drives up stock prices. That in turn makes the stock market more attractive relative to bonds and other things, which leads to even more flows into the stock market. So, as a lot of people have pointed out, low interest rates have been the support for high stock prices and rising stock prices over the last decade, but it's also a function of the fact that there just isn't anywhere else to spend that money productively in the economy. Banks are not rushing to make business loans because businesses are not rushing to borrow. And it's not just because of COVID, it predated it by a long time. The other thing, of course, is that low interest rates do make future cash flows more valuable, which reinforces this whole thing. The final piece is that this low interest rates that lead to a lack of economic dynamism and slow growth and a big shift of resources into financial markets creates the stage where we have repeated bubbles. Now, I'm not saying that we're in a bubble right now, because I believe that ultimately bubbles are caused when the stock market and asset prices get ahead of the underlying financial fundamentals. In other words, stock prices get too high for the financial resources behind them. Right now, with the Fed doing what it's doing and with huge amounts of cash in the banking system, I don't believe we are looking at the possibility of a forced withdrawal of liquidity in the stock market. But nevertheless, these long-term uptrends like the one we've been in are punctuated by periodic pullbacks as stocks get hideously overvalued, like some of them are. I still think Tesla is a good example of a badly overvalued company that is due for a pullback. I believe Bitcoin is as well. But the bottom line is that you can have big corrections right throughout an entire period like this. And it all goes back to the fact of asking yourself, why do people invest so much money in these stocks in the first place? Because there's no alternative. TINA, TINA. And it's not just bonds, it's also that the real economy is not providing alternatives to make money. And so people pile into whatever story stock appears to be making money, at least on paper. Well, that's my argument for this week. I think it's challenging, I think it's unusual, and I think it's something a lot of people need to think about, because even if you're an investor, even if you're somebody who's worried that high interest rates will undercut your stock valuations and potentially your stock gains, the reality is that in the long run, you are like Wile E. Coyote walking out into thin air. Eventually, the stock market runs out of that gas. Eventually, there needs to be a reorientation of liquidity and investment back to the real economy. And one of the things that's going to drive that is, paradoxically, a rise in interest rates to make the stock market less attractive. Anyway, that's my message for today. I don't know when that's coming. It'll ultimately be a political decision, as so many major causes of changes in the stock market are. I'll talk to you next week. Have a good one.